Welcome to the Deep Dive. Today we're digging into Dana Incorporated's Q2 2025 earnings call. And this one was pretty interesting.
Yeah, interesting is a good word because, on the surface, the headline numbers, they looked like a miss.
A definite miss in places. But the market, totally different reaction. Overwhelmingly positive, actually. So what gives?
Exactly. It's a classic case of needing to look past those headlines. So our mission today is to kind of peel back those layers, distill what management really talked about in terms of strategy, financial shifts, and ultimately show you why investors basically shrugged off the initial figures.
And bid the stock up pretty significantly.
Right, because this wasn't just about Q2 results. It was like a whole transformation story unfolding.
Okay, so let's start where most people did with those initial Q2 2025 numbers. Dana reported adjusted earnings per share, just 5 cents.
5 cents. And compare that to the consensus estimate, which was $1.39.
Yeah, quite a gap. Significant miss. And revenue, same story, really.
Revenue from continuing operations came in at $1.95 billion. The expectation was closer to $2.55 billion.
So well short of consensus there, too, and it represents about a 5% decrease compared to last year. On paper, well, it doesn't sound great, does it?
No, you definitely raise an eyebrow just looking at that. But here's where things start to shift a bit. Adjusted EBITDA for continuing ops. That showed real improvement.
Okay.
Hit $145 million. Now that translates to a 7.5% margin.
And that margin number is key, right?
Absolutely.
Yeah.
It's a 210 basis point increase year over year. So think about that, a 2.1 percentage point jump in profitability on that key metric, even with lower revenue.
Right. That's a different picture. What about cash flow?
Operating cash flow for the quarter was $36 million. Adjusted free cash flow, though, dipped slightly negative, negative $5 million.
So, okay, revenue and EPS misses, but a pretty solid jump in EBITDA margins. What was driving that margin improvement? Was it purely cost-cutting, or was there something else going on operationally?
Well, cost savings were definitely a big piece of it, yeah. The company realized $59 million just in Q2.
$59 million.
Which brings their total for the year so far up to an impressive $110 million.
That's real money.
That's real money hitting the bottom line, exactly. But it wasn't just about cutting. They were also very active returning capital to shareholders.
The buybacks.
Yep. Dana repurchased 14.6 million shares in Q2. That returned $257 million to shareholders.
Yeah, that sends a pretty clear signal, doesn't it? Especially when you're also raising your full-year guidance.
It really does. And that revised guidance wasn't just a minor tweak either.
Right. So put those revised numbers into perspective for us. How significant was that raise?
It was more than just, fine-tuning. For their full-year 2025 guidance, this is for continuing operations, mind you, they actually raised the sales outlook.
Raised sales.
Between $7.25 billion and $7.55 billion. Adjusted EBITDA guidance also saw a significant bump, up to a range of $540 million to $610 million.
Wow, and free cash flow.
Adjusted free cash flow target was also lifted pretty substantially, now looking at $225 million to $325 million.
So this wasn't just nudging numbers. This was management showing real confidence in where they're headed.
Absolutely. A strong vote of confidence. And that confidence, combined with the operational moves, well, the market noticed.
Clearly, because that positive guidance, it directly fueled that immediate market reaction we mentioned earlier, right?
Totally. Despite those headline misses on EPS and revenue, the response was, like you said, overwhelmingly positive. Shares jumped in pre-market during the call.
Yeah, you don't see that every day.
And closed up 7.2% on the day. Volume was way up, too. So for someone just scanning headlines, what are they missing? What's the key thing that flipped the script?
And here's where it gets really interesting, yeah.
It's the strategic transformation. The number one driver, really, behind this whole positive reaction is Dana signing a definitive agreement to sell its off-highway business.
To Allison, right? For a big number.
To Allison, yeah. For $2.7 billion, they expect net cash proceeds of about $2.4 billion from that.
And when's that expected to close?
Anticipated closing is late Q4 2025. And this isn't just selling off a division. It's a really profound strategic pivot for the company.
Profound pivot. Okay. Why is shedding off highway, even for $2.4 billion cash, so transformational? Was it seen as dragging them down? Did analysts push back at all on selling it?
That's a great question because it really gets to the heart of why this move resonated so much. For a while, Dana was seen by some investors as, maybe a bit sprawling.
A conglomerate type feel.
Kind of, yeah. Maybe the true value was obscured by having these diverse segments, some performing better than others. So this divestiture, it's not just a sale, it's like a surgical strike aimed right at that perception.
Streamlining the focus.
Exactly. Management kept emphasizing how it significantly strengthens the balance sheet. And critically, it lets them focus squarely on their core, the light and commercial vehicle driveline content.
So becoming a more focused player.
More focused, more agile. They framed it as allowing capital to flow where it really generates the most value for shareholders. It's about becoming a simpler, cleaner story. And the market loves that.
Okay, so strengthening the balance sheet is job one with that cash.
Yeah.
Makes sense. Anything else? Reinvestment in the core, or is it mostly debt paid down and returns?
It's heavily, heavily weighted towards deleveraging and capital returns right now. That's a huge part of the de-risking narrative here.
Got it.
The proceeds are primarily earmarked for substantial debt reduction. They're targeting net leverage of approximately 1x over the cycle.
1 times net leverage. That's pretty conservative.
It's incredibly strong, gives them massive flexibility going forward. And then there's the capital return program, which frankly is pretty aggressive.
Yeah, tell us about that. $1 billion.
A new $1 billion capital return authorization through 2027. And get this, the target just for this year, 2025, was raised to about $600 million.
$600 million in 1 year. Wow.
They expect to end the year with roughly 110 million shares outstanding. That's like a 25% reduction in shares year over year. Huge reduction.
25% share count reduction. That's massive. And they're not done yet.
Nope. They flagged another $100 to $150 million in share repurchases expected just in Q3.
Lots of companies talk about simplifying or returning value, but pairing a big divestiture like this with such specific, aggressive capital return targets, that feels different.
It absolutely is. It's not just vague promises. It's a clear, quantifiable commitment. And that, plus the balance sheet repair, really form the core of why the market got so excited.
Okay, so simplify, pay down debt, buy back stock. That's a clear path. But what about the remaining business? They also talked about pretty ambitious margin targets, right?
They did. And that's the other crucial part of the story. They're aggressively going after margin expansion for the continuing operations.
Right, aiming for that 10% adjusted EBITDA margin by 2026. That's a bold target. How are they planning to actually get there? What are the levers?
It's definitely ambitious, but they laid out a multi-pronged approach, and they've actually expanded their cost savings program target again, now aiming for $310 million by 2026.
$310 million in savings.
Okay, and they broke down how they bridge to that 10% margin. First, just the annualization of those cost savings we already talked about, that's expected to add 100 basis points.
Okay, so just letting existing efforts fully kick in. Makes sense. What else? New business wins. Playing a part.
Oh yeah, new business is a big piece. They expect accretive new business backlog to contribute another 60 basis points.
60 basis points. Where's that coming from specifically?
That's from an expected $300 million bump in sales from some pretty significant programs. New business with JLR.
Okay.
Volume uplift on Ford's Super Duty, Ranger, and Bronco programs. Those are huge sellers, plus some new Wrangler variants. So these are substantial, high-value programs.
Got it. And then there was this concept of stranded costs. Can you unpack that a bit? What are those, and how does getting rid of them help margins?
Right, stranded costs. So basically, when you sell off a big piece of your business, you still have certain corporate overhead costs that used to be allocated to that business or covered by it.
Like central IT systems, maybe global insurance policies, audit fees, things like that.
Exactly. Stuff that doesn't physically go with the sold unit. You don't just, flip a switch and they disappear the day the deal closes.
It's time to unwind.
It takes time. Dana expects eliminating these stranded costs will add about 50 basis points to their margin. They think they can get rid of at least half of the remaining, say, $40 million of these by the end of 2026.
And fully gone by 2027.
Fully gone by 2027 is the plan. It's detailed work, but it adds up. And then finally, just general operational performance improvements are expected to kick in another 40 basis points.
Okay, so it's savings, new profitable business, shedding those legacy overheads, and just running things better day to day. Makes sense. What about external factors? Like tariffs have been a headache for everyone. How are they handling that?
Yeah, they tackled tariffs head on. They expect over 80% recovery for the full year 2025.
80% recovery.
They did say Q2 had about an 80 basis point headwind from tariffs, but that was mostly just timing. They expect to recover most of that next year, so they seem to have a pretty clear handle on it.
And looking across their different vehicle segments, light vehicles versus commercial vehicles.
Yeah.
Seeing different trends there.
Definitely seeing different trends. The light vehicle market, especially North American light trucks, which is really core for the new Dana, those schedules are holding stable. That's good news.
But commercial vehicles.
That's where the softness is. The North American commercial vehicle market, orders are running at about half of last year's levels.
Half. Wow. Why so weak?
A lot of it seems to be tied to tariff uncertainty, just causing hesitation in the market. Now, this weakness is partly offset by some moderate strength they're seeing in South America, particularly Brazil, and also in Europe.
Okay, but here's what seems really important, and maybe why the market liked the guidance so much.
Management said they're baking in a pessimistic view for North American commercial, right?
Exactly. They've factored a pessimistic view into their outlook. And crucially, they are not relying on some big...
Well, particularly as the off-highway business, which is gone, and the commercial vehicle business, which is softening those, tend to have longer supply lines and higher inventory needs. So as those scale back relative to the core light vehicle business, it should mean better cash conversion from ongoing operations.
Okay, so pulling this all together, it really does become crystal clear why the market reacted positively, even with those initial misses. It wasn't about the rearview mirror, it was about the road ahead.
Totally. It was a signal of strong investor confidence in Dana's strategic narrative, that intense focus on simplifying the portfolio, massively reducing debt, and that really robust capital return program that just resonated way more than the short-term quarterly numbers.
It really was, like you said at the start, a strategy story.
And that story has already paid off for investors who saw it early. And Dana's stock has just, well, surged.
Yeah, the numbers are pretty striking.
The 1-month gain is over 13%, 3 months, almost 15%, and the 1-year gain, over 70%.
70% in a year.
Yeah. And that's crushing the broader S&P 500 and the industrials ETF, the XLI. So this isn't just the market lifting all boats. This is very much a company-specific alpha story unfolding.
And the analysts seem to be catching on too, right? Seeing price target increases.
Definitely. Sentiment has turned much more bullish. You saw multiple price target raises after the deal announcements. UBS, RBC, Deutsche Bank, all bumping their targets.
So looking ahead, what are the key catalysts? The things investors should really be watching to see if this multi-year transformation stays on track.
Okay, several key things. First, obviously, getting the regulatory approvals and actually closing that off-highway sale late in Q4 this year. That's step one.
Makes sense. Then what?
Then it's all about the execution on those capital returns. Watching the cadence, how quickly they actually deploy that buyback authorization.
Show me the money, basically.
Pretty much. Also, continuing to make progress on full tariff recovery and hitting those cost reduction milestones. Those need to keep delivering. And finally, you might see further sell-side re-ratings. As more analysts kind of fully grasp this new Dana narrative, you could see more upgrades or target bumps.
So the overarching theme for management is this multi-year arc. Simplify, deleverage, grind margins up towards that 10%, and compound returns for shareholders.
Exactly. Transforming Dana into a much cleaner, cash return-focused company, moving it beyond just being seen as another cyclical auto parts supplier.
Okay, perfect time then for our not financial advice segment.
Yeah.
Think of this as just a hypothetical pitch. Food for thought from a fictional analyst to their equally fictional investment committee.
Right. Just an idea to mull over. Given this whole strategic pivot at Dana and management being pretty vocal that they think the shares are significantly undervalued, here's a thought for maybe a more aggressive, long-term oriented investor.
Okay, lay it on us. The setup.
Consider a straightforward long position in Dana common stock, tickers Dan. The idea here is to target a valuation that reflects what the company could look like in 2026. Meaning you factor in that stated 10% adjusted EBITDA margin goal, you combine it with that massive 25% reduction in share count they're aiming for by year-end 25, and you price in that substantially deleveraged balance sheet, that 1x net leverage target.
And management's commentary backs this up.
Yeah, they basically signal that they'll buy back more faster as cash flow keeps improving. So that aggressive share count reduction really underpins the potential valuation upside per share.
Okay, that's the long Dan pitch. What about the twist you mentioned? The paired trade.
Right, the twist. To potentially amplify the Dana-specific return and hedge out some of the general market or industrial sector noise, consider a paired trade.
Long Dan. Short something else.
Exactly. Go long Dan, and at the same time, initiate a short position on the Industrial Select Sector SPDR Fund, the XLI ETF.
Okay, why short the industrial sector against the Dana long?
The logic is to try and isolate the alpha from Dana's specific transformation. Remember, management explicitly said they're not relying on a broader cyclical upswing to hit their targets.
So you're betting on Dana's execution, regardless of what the water industrial economy does.
Precisely. It's a play on Dana successfully transforming into that cleaner cash returns story and breaking away from just being valued as a generic cyclical auto parts name. You capture the Dana-specific upside while hedging out some of the broader market beta.
Interesting concept. Okay, that wraps up our deep dive into Dana's Q2 2025 earnings call and the strategy behind the numbers.
Yeah, what we've seen is a company really in the middle of a major strategic shift. Those initial financials, they kind of masked the real story.
Absolutely. Management laid out a really compelling future. Simplifying the business, getting aggressive on deleveraging, and showing a very robust commitment to shareholder returns.
And the market's positive reaction seems to validate that forward-looking narrative, doesn't it?
It certainly does. Now, just the usual reminder for everyone listening.
Right. Remember, everything we discussed today is purely for informational purposes. It is absolutely not financial advice.
Always do your own research. Consider your own circumstances and talk to a qualified financial professional before making any investment decisions.
Definitely.
So here's a final provocative thought to leave you with. As Dana transforms into this new Dana, really focused on light vehicles in North America, what kind of hidden opportunities might that create?
You mean in the segments they're leaving or de-emphasizing, like commercial vehicles or off-highway?
Exactly. Could it open doors for other players? Or maybe even for Dana itself down the road, perhaps through different growth strategies?
And maybe think bigger, too. What other companies out there might be quietly planning similar strategic divestitures? Moves that could unlock hidden value that the market just isn't seeing yet.
Definitely some food for thought there.